Hey everyone, and welcome to the last video from not only chapter 12, but our discussion on financial institutions. And what we're going to be doing today is just revisiting the financial crises of 2007 and 2020. And now that we have a better understanding of not only the instruments in the economy, but the institutions that trade them and construct them, we wanted to revisit both of them to add a few more layers to this building of understanding that you guys have on what happened in 2007 and what is still happening right now as we recover from the financial crisis related with the COVID pandemic. So, if you remember, everything from 2007 was really sourced in the housing market. And what you see in this graph below is a tracking of relative indexed housing prices and rents starting in 1987. So at 1987, they're both priced at 1. And as you can see, housing prices and rents tracked each other really closely until about 1999. So this means that they're growing at about the same rate. However, after 1999, housing prices just started to surge and skyrocket, whereas rents continued to grow at about the same rate. And there's a couple of reasons why this happened. You know a couple of them from either this class or your background understanding of the financial crisis, but there are some more legitimate reasons as well. For example, rent ceilings in major cities like San Francisco that had housing surges related with the technology growth in that area, those dramatically increased housing prices, but rents could only be capped at a constant growth rate. And so there's, of course, going to be a bit of a departure from housing prices from rents there. However, most of the rest of this is fueled by the eagerness to give out subprime mortgages as the demand from the financial system for mortgages to create mortgage backed products surged. And this continued all the way until about 2005 when things started to plateau in the housing market and the housing bubble started to burst. And it continued to burst all the way up until about 2011 when they, sure enough, reached back to about their indexing of each other. Now, as a worrisome sign, you can see that before 2020, housing prices did start to surge past rents once again, so we'll have to keep an eye and see what's happening in the housing market related to that. However, if we shift back in time to April of 2007, Ben Bernanke, then the chairman of the Fed, gave the following statement. We believe the effect of the troubles in the subprime sector on the broader housing market will likely be limited, and we do not expect significant spillovers from the subprime market to the rest of the economy or the financial system. So at this point, this is about 18 months into the housing bubble bursting, and still there was not really an understanding about how exposed the financial system was to the housing market. And there was this weird delay where mortgage backed securities, CDOs, etc., continued to perform quite well despite the slow bursting of all the mortgages that comprised of these derivative assets. And because a lot of this wasn't well tracked, even Ben Bernanke didn't really understand the exposure to the broader financial system, both in terms of the quantity of the size of the economy that is reliant on mortgages, as well as who is holding them. You know, insurance like AIG, and how one-sided and unhedged, exposed that these large investment banks were to mortgage prices. However, we started to get our first hints of what was going to come in August of 2007 when BNP Paribas, another large bank based in France, announced that investors in three of its investment funds would not be allowed to redeem their shares. And the reason why they did this is one that you should understand now. They were trying to prevent a run from within their investment funds. The mortgage-backed securities that comprise of the portfolios in these investment funds had declined in value so much that BNP Paribas was worried that their funds would go bankrupt if they let investors cash out their shares. In other terms, we just were seeing the beginning of a bank run, and BNP Paribas was trying to prevent it. And this really got things going. After BNP Paribas made the announcement, lenders quickly stopped giving funds to financial firms. The commercial paper market just completely dried up, and any sort of financial transaction that was taking place required strictly treasury bonds as collateral. Oftentimes, pre 2007, we saw MBSs used a lot of times as collateral, and so this was a very significant shift towards exclusively treasuries, which were deemed at this point significantly safer. And then in August of 2008, so a full year after all of this started to erode, we really saw the worst of the financial crisis. At this point, 25% of subprime mortgages in the United States were at least 30 days overdue. So if you think of like the worst third of American mortgage holders, a quarter of them are just not paying their mortgages anymore, which means that the MBSs that relied on these mortgages just were losing all value. And that's when things really went sideways. On September 15th, 2008, Lehman Brothers filed for bankruptcy protection, and it was the first large mega investment bank to do so. On the same day, Merrill Lynch sold itself to Bank of America, and that was to avoid having to go into bankruptcy. And the very next day, on September 16th, a money market mutual fund called Reserve Primary announced that their shares would be worth less than $1, and this caused that run in mutual funds that BNP Paribas was trying to prevent. So we're seeing the equivalent of a bank run that we were seeing in the 1930s. This is happening in the entire financial system at this point. And the mutual fund market at this point just completely dried up, and trading on all securitized loans just stopped. So not only mortgage-backed securities, but broader asset-backed securities. So those would include things like an auto loan. And on September 18th, so 2 days after this, the Fed drove down their short term interest rates by cutting the Fed funds rate. So you can see September of 2007 is right about here. We had the Fed funds rate was pretty flat for about a year and a half, and then bam, the Fed just started cutting rates rapidly. Then in October of 2007, the Fed announced that it would start up what was called the Commercial Paper Funding Facility, which was the first time since the Great Depression that the Fed lent paper directly to corporations. And in September of 2008, the Fed and Treasury introduced the TARP program, which directly bought out all these subprime worthless assets. And then by the end of December of 2008, the Fed had spent over $1.2 trillion trying to stabilize the financial system. And in 2009, when we're near the backside of the financial crisis, they conducted a stress test to try and see whether or not the financial system would handle the recession if it got any worse. Because at this point, they didn't understand how much exposure the financial system still had. However, they did find that if the recession got worse, that these financial institutions would only need $100 billion of maximum new capital to deal with even the worst possible Great Depression sized economic downturn, which compared to the $1.2 trillion that they had spent in just over 3 months wasn't so bad. And this really marked the beginning of the recovery from the recession, because this gave investors some confidence for the first time in the financial system and started to loosen up investors' wallets a little bit as they became more willing to dip their toes into the water, if you will, for the financial system. Now let's move on to 2020. Now, predating 2020 a little bit, in 2019, the Fed cut federal funds rates twice already because of slowing economic growth. So we had about 12 years or 10 years of economic recovery and consistent growth. However, as that was starting to peter out, the Fed cut the Fed funds rate so that they could try and stimulate economic growth further, because they didn't like the direction the economy was going, which means that in March 2020, they had to almost immediately bring the federal funds rate down right to zero. And we don't need to go into too many details about the pandemic, but If you remember, it started all in about mid-March here in the United States, and just 2 weeks later, the U.S. CARES Act was passed on March 27th of 2020, and that gave more than $2 trillion in aid, not only to the financial system, but to the broader American public. And what the Fed did is they had to distribute the CARES Act funds. So they revived the lending facilities that it had last used in 2009. And we're going to get into more in detail about all these lending facilities and what they did in a couple chapters. But they broadly did two things. You had liquidity facilities and credit facilities. In liquidity facilities, we're building upon the role as lender of last resort to commercial banks. And so even though the banking system actually fared quite well during the financial crisis, there were still significant concerns about liquidity risks. Now, luckily, there was no experienced severe bank run because of just the, maybe you could say, ludicrousness of the circumstances, but there were still significant concerns. And so the Fed opened up these facilities to give liquidity specifically and primarily for otherwise solvent banks that are dealing with a liquidity crisis directly related to the financial crisis. Now, they also introduced credit facilities, which provided funds to non financial firms by granting loans or buying bonds. And like I said, we're going to get more in depth about what that means later on. But this was an important vehicle for CARES Act funds because the CARES Act, as I mentioned, was not focused on the financial system. It was on the broader American public and specifically corporations in the United States. And that's what the Fed's main job really ended up being during the financial crisis, which was to give these loans and bonds to major companies. Now, these credit facilities were a bit controversial. You might have heard a lot in the news, mainly about the airline industry, because if you look at the total percentage, the airline industry ended up getting about 80% loans and 20% bonds. So we had a little bit of both going on here, but there was a significant difference because a lot of these bonds, the government is going to get paid back in the next couple years. However, these loans or grants will never get paid back.